The comments keep telling me these high yield funds are trash, that the dividends are fake, and that I should just buy the S&P 500 index and wait 40 years to be rich. Well, I'm tired of arguing with strangers on the internet. So today, I'm going to argue with artificial intelligence on the internet instead. But not just any AI. No, I'm going to feed my entire life savings, every risky high yield trade, into investing.com's Warren AI. It's trained on vetted, real time financial data from trusted sources. I asked it to roast my portfolio, rip my strategy to shreds, and tell me exactly why I'm going to go broke. Then I asked it to fix the portfolio for me. The catch? Well, whatever portfolio this AI builds to fix my mess, it has to pay me $2,000 a month in withdrawable cash. Right now, today, not off in the future. Oh, and since they named it Warren AI, I'm going to refer to it as if it's Warren Buffett. So let's see if the Oracle of Omaha can actually pay my mortgage, or if he'll just tell me to get back to my night shift. Okay, first I'll mention that investing.com was kind enough to provide me with a license to InvestingPro, where Warren AI is located. So I'd like to thank them for that. And also mention that they've given you viewers a 15% discount if you want to sign up to InvestingPro. You can use the link down in the description and the code Dividends After Dark to sign up. So with that said, I've loaded up Warren AI, and when I looked at what Investing Pro offered, Warren AI was kind of the most interesting to me just because I like playing around with these chatbots and seeing what kind of stuff they spit out. I've used ChatGPT, Claude, and Gemini a little bit to look at financial stuff, and I really wasn't satisfied with the answers that they gave. They start hallucinating and things like that. So I'm hoping that Warren AI, with its specific training, won't have as much strange quirks like that. It'll give some real feedback backed by numbers. Haven't played around with it very much before right now, so that you can see my initial reaction to it. You can see that in real time and what I think. So I've put together a prompt, which I will paste in here now and send to it. And probably while it thinks about its response, we can go over what the prompt says. So I told it, act as Warren Buffett. I'm a 30-something entrepreneur who just quit my night job to live off of this dividend portfolio. I need to withdraw $2,000 per month from this account to pay bills. The portfolio: Coney 96 shares, HHIS 2,310 shares, MSTY 77 shares, NVDY 1,667, TSLY 510, ULTY 96, and WNTR 33. Then I told it, first, roast the current holdings in my portfolio. Be brutally honest about the risks, the yield traps, and the garbage I'm holding. Don't hold back. Second, give me 2 plans to fix this, keeping the $2,000 per month withdrawal in mind. Plan A is the nuclear option. If I sold everything today, build me the perfect Buffett-approved portfolio that still generates enough cash flow or growth to support my $2,000 per month withdrawal. Plan B, the lock-in. I refuse to sell a single share. Using only the incoming dividends from my current portfolio. And then I forgot to update this because I wrote this last week. I was going to update it to where it's currently at. We'll see how it did though. Tell me exactly what to buy each month to de-risk this portfolio over the next 5 years. So let's see what it says. Brace yourself. With a portfolio like this, living off dividends could turn into a financial horror show. Fast. Most of your holdings are high-yield junk, engineered for sizzle, not safety. That $2,000 per month withdrawal goal, you're banking on a rickety foundation that could collapse with one bad quarter. Yeah, that's pretty rough. And it looks like it could have came straight from the YouTube comment section of my videos. So good on you guys commenting. You're just like Warren Buffett, apparently. Portfolio roast. Where's the moat and where's the margin? Let's tear off the Band-Aid. Coney, HHIS, Misty, NVDY, TSLY, Alti, Winter. These are not household names, nor do they appear in any reputable dividend aristocrat lists. Most are likely synthetic, high-yield ETFs or speculative vehicles. Their dividends are juicy until they're not. Many are built to self-destruct when markets wobble. So I want to point out something that I noticed here. I don't love that this AI chatbot built on real financial data is saying things like likely. It should know what these ETFs are. They're listed on the markets. Warren AI should have that data and be using it, not essentially hallucinating and guessing at what the answer is. That aside, let's continue. Yield traps everywhere. High yield is often code for capital loss in disguise. These products can and often do slash payouts or bleed away principal. When the next bear market hits, you'll be left holding the bag, except that the bag is empty. No real economic moat. Buffett rule number one, own businesses that print cash and dominate their industries for decades. These tickers, they have no moat, no pricing power, and likely, there's that likely again, no real business behind the yield. You know what, in this case, likely is okay because that is speculative. Garbage meter, 9.5 out of 10. If you want reliable income, this is not the way. It's more like betting on a leaky boat to cross the Atlantic. Now we're going to get into the rebuilds. This is really what I was most interested in. You could probably tell by the way I worded my prompt. I wanted it to roast me because that's all I've been hearing since I revealed my portfolio to YouTube, is these roasts. I thought I'd let AI get in on that action. So the nuclear option to rebuild everything. Sell everything, start fresh. Here's how a Buffett playbook portfolio looks. But will it make me enough money? Blue chip dividends with examples, not real specifics. GNG, KO, PG, MCD, PEP, AAPL. The only one I don't recognize is J&J. Otherwise, we got Coca-Cola, Procter & Gamble, McDonald's, PepsiCo, and Apple, none of which pay super high dividends. They want 50% allocation into these funds, and they expect the total return to be, yield 2 to 3% in dividends plus growth. Why Buffett would approve these is because they're durable brands with pricing power. Next, it recommends I allocate 20% to US utilities, including NEE, SO, and DUK. Their yield looks to be 3 to 4%, and they want this for the regulated steady cash flow. Next, 15% to financial powerhouses, including JPM, BLK, and BAC. They have 2 to 3% yield and buybacks. This is in the portfolio as a fortress for balance sheets. 10% to US Treasuries, laddered, short, and intermediate. 4 to 5% yield currently, and this is a safety net for liquidity. Finally, 5% to REITs, including O and PLD. They give 4 to 5% yield, and Buffett approves them because they are real assets and a hedge against inflation. How it works: $2,000 per month. That means we need $24,000 per year. Target 3.5% yield plus 2 to 4% dividend growth. We need $700,000 in principal for pure income, less if you withdraw some of the growth. So here's where it falls apart for me. I told it to sell my current portfolio, I told it how many shares I have. This should be backed by real data and be able to find the current share price. It should know that I do not have $700,000 invested. Therefore, this portfolio cannot work for my needs. But why it pretends like it works is that you swap fool's gold for real businesses that survive recessions and compound wealth. The downside is a lower headline yield, but actual income stays reliable and grows. And let's face it, that would be great. I would love that. If I had $700,000 laying around, I wouldn't be in the admittedly risky, super high yield funds that I am. I don't know how else to say that, Let's continue and look at plan B, and then maybe we'll ask some more questions of Mr. AI Buffett here. So plan B is where we don't allow any selling. I'm curious to see if it's just going to assume I have an extra $600,000 in this one. So assume your current monthly dividend. Okay. So it didn't even do the work of figuring out what this would be. It's just asking me to put it in. Whatever. Here's the reality check and Buffettification strategy. Reinvest every dollar. I already told it I can't. I need to withdraw some. Each month, use incoming dividends to buy shares of S&P 500 dividend leaders like vidIQ ETF or direct blue chips like PepsiCo, J&J, I should probably look up what that is, and Coca-Cola. Monthly Buffett buys. Priority 1, the consumer staples like Coca-Cola, PG for sustainability. Priority number 2, railroads and utilities if they're accessible. Priority 3, financials with fortress balance sheets. Think JP Morgan. The third component, de-risking over 5 years. Let compounding work. New purchases steadily dilute your garbage holdings. If the yield falls, don't chase more high-yield ETFs. Stick with quality, even if it means less income now for more later. What we can expect in the first 2 years, income might drop if your high yielders cut payouts, which are likely. And through 3 to 5, the portfolio should start to stabilize, capital losses will slow down, and income starts climbing steadily in a modest but safe way. Final thoughts. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. I believe that's an actual Warren Buffett quote. Your current strategy, it's a short-term yield party with a long-term hangover. Buffett's way, sleep well at night, accept lower yield for higher certainty. And then it says that this content is for informational purposes only and not investment advice. So I'm going to ask it here. So I asked it, I don't have $700,000 to create this portfolio. What can I do with the $96,000 I do have that can keep me from going back to the full-time night shift? It says withdrawal rate reality check. Let's get brutally honest. A sustainable withdrawal rate for most stock portfolios is 4 to 5% per year, or roughly $4,000 to $4,800 per year on a $96,000 portfolio, about $333 to $400 per month. You're aiming for 6 times that. No basket of S&P 500 stalwarts or even high-yield ETFs can deliver $2,000 per month in income without extreme risk, rapid principal erosion, or both. The stretch strategies and their dangers. Option number 1, high-yield portfolio. You could assemble a basket of ultra-high-yield stocks, closed-end funds, or covered call ETFs yielding 12 to 20%, but these income engines often cut dividends, lose capital, or both, leaving you with less income and a shrinking nest egg each year. And I have seen that with the Yield Max portfolio in particular. It has both lost capital and shrunk dividends. So we'll see how it goes long term. An example they give of this would be that the S&P 500's average yield is just above 1.5%. Even dividend aristocrats rarely top 4%. Anything paying 8 to 12% carries major risk. And then it suggests to look at my current holdings to see that risk. Yep. Option 2, growth and partial drawdown. Tilt toward a blend of dividend growth stocks, S&P 500 blue chips, healthcare, industrials, and accept that some withdrawals will come from selling off shares. This stretches your capital further, but still likely runs out before 10 years, unless markets outperform history. And option 3, the side hustle buffer. Supplement withdrawals with part-time flexible work, at least for a few years, to let the portfolio compound and reduce the withdrawal strain. Sample blueprint for squeezing the most out of $96,000. S&P 500 funds, expected yield 1.5%. That could give you about $120 in monthly income. Principal erosion, severe. I don't understand that. Why does it say that there's severe principal erosion? I think it's probably got that backwards. This is the safest option, but the income is far too low for what I need. The other portfolio type, high yield ETFs, 8 to 10% expected yield, which is risky. You'd get $640 to $800 per month, and principal erosion would be likely. That I understand. Warren AI's take is that you get higher income, but it will be unsustainable long term. Yield trap stocks, 15% or higher, or in other words, junk. Your monthly income could grow to $1,200 or more, but your principal will erode rapidly and your principal ends up at high risk, so they wouldn't recommend it. If you mix of growth stocks in with it, you get 3 to 5% yield plus growth. So your monthly income could be $240 to $400 per month, and your principal erosion would be moderate. You get some growth, but not enough. So in all these cases, the monthly income is much too low for me. I'm currently getting about $3,200 a month, which allows me to safely withdraw $2,000 to top up what I need for my family's budget, and then still have $1,200 left to reinvest. Warren's key insight: even the riskiest portfolios can't reliably generate $2,000 per month without eating into principal. Why markets can't magically fix this: S&P 500 up 17.7% in the past year, but with a yield of just 1.5%. That's less than $1,500 a year on $96,000. Even if you score a year like that, next year could be flat or down. And see the recent volatility and outflows. Reaching for high yields is how portfolios implode, especially when regular withdrawals are required. The hard truth and best moves. Reality: $96,000 can't deliver $2,000 per month safely in stocks alone. Any setup that tries will likely force you back to work once markets turn or dividends get cut. The best play: lower your withdrawal rate if possible. Even $1,000 per month cuts your risk in half. Consider a blend. Keep most assets in blue chip dividend stocks like S&P 500 aristocrats, healthcare, and utilities, and supplement with flexible work, side hustles, or other income streams. I did tell it I'm an entrepreneur. It seems to have kind of ignored that, but I do supplement with my tech business, which brings in upwards of $10,000 to $15,000 per month, but some of that is set aside for expenses and taxes, so I only draw about $6,600 of it per month, and I use my dividend portfolio to top up the other $2,000 or so that my family needs. So it says that if you must withdraw $2,000 per month, accept that principal will steadily decline. Plan for a 4 to 5 year runway, not a lifetime portfolio. And that's a key insight, and that's what I'm doing. I don't talk about it all the time because it's not super relevant to the exact content and what I'm talking about in each video. But the whole plan of this portfolio I currently have is to give me time to ramp up my tech business to hopefully someday soon replace all the income I need. And then the portfolio can just sit to the side and grow. That is the goal. So it's nice that Warren sees that. Next steps it gives me for maximum survival. Rebuild your portfolio for quality and diversification. Focus on S&P 500 dividend growers, utilities, and select high yield but stable REITs and CEFs. Reinvest any leftover dividends, which I am doing already. Compounding matters even on a small scale. Track your withdrawal rate monthly. If your balance starts dropping fast, consider pausing or reducing withdrawals. And finally, stay flexible. If markets surge, let your balance recover instead of increasing withdrawals. Yes, that will be the plan. Okay, I'm going to stop with Warren AI there. It basically told me what I expected it to. I didn't expect it to praise my portfolio in any way that would be quite unrealistic. So really, Warren Buffett thinks my strategy is trash. A lot of the commenters in YouTube think it's trash. And that's really why I chose to start the channel, to share how this admittedly risky idea is going, and so that other people can see how it works, if it works, and they can see if it's something that they want to take a chance on themselves without needing to go ahead and take that shot. So there you have it. Warren AI just confirmed what half my comment section has been screaming at me. Mathematically, trying to pull $2,000 a month out of a $96,000 portfolio is insane by traditional standards. Yeah, if I follow the AI's advice and pivot to blue chip safety, I can protect my capital. But my cash flow drops to a trickle. And you know what happens then? I have to put my tech business on hold, pack a lunch, and go back to working weekend night shifts just to pay my bills. The AI is optimizing for a perfect spreadsheet 30 years from now. I'm optimizing for freedom today. This portfolio is a conscious trade-off. Am I taking on massive risk with these high yield funds? Absolutely. But it's the price I'm willing to pay to bet on myself as an entrepreneur instead of a corporation. So I'm putting it to you guys. Who's right? Are you Team Buffett AI with the safe, slow path? Or Team Dividends After Dark, taking smarter, calculated shots for cash flow right now? Let me know in the comments. And hey, if you want to see what Warren AI has to say about your portfolio, maybe you're playing it too safe, or maybe you're even crazier than I am. Go run your own numbers. I partnered with investing.com to get you guys 15% off their pro tools. Just use the code Dividends After Dark at the link in the description. Go get roasted by the AI and come back here and tell me what it told you to sell. See you next time.